Well, I've come to the conclusion, because I have my own index to look at, which is my 50 plus private companies, that 50% of this inflation is actually because of supply chain that still hasn't been fixed. Deglobalization, I'll give you just a case study. I've used it so many times. Let's say I'm making gym equipment in Fargo, North Dakota, where I am. And prior to the pandemic, we used to buy all of our metal, our barbells, our screws, some of the infrastructure for the benches from Asia, from China, from Vietnam, from other countries where it was 30% cheaper. We can't get those supplies anymore, partly because the ship that has it on it is stuck at LA Port. Yes, it's still a problem. LA Port has not been fixed yet. And so we are forced to go buy that steel made here domestically. Now, whether that's a good thing or bad thing, we can debate that till the cows come home. However, it's 33% more expensive. So we take those barbells and those benches, mark them up 33%, sell them into an ever increasing demand market. Our sales have not slowed, but it's 30% more expensive. That, my friends, is inflation. And it's not going to change until I can buy those barbells again in Asia at 30% less, which is no time soon. I don't think it's possible to deglobalize, and I'll tell you why. There's certain product categories, once they become commodities, are better manufactured in low-cost countries.
Yeah.
And the idea that you shouldn't manufacture socks in Vietnam because of some protectionism, or the fact that you'd rather pay 5 times more for socks, that makes no sense whatsoever. Yet, if you're building a new chip that actually can fuel AI, artificial intelligence, yeah, I can see I'd rather do that domestically and keep that away from our economic competitors like China, who don't want to play in a level playing field unless they're willing to cooperate. And that's the leverage we have over them. So, different product categories. And I would argue energy, we should remain self sufficient. That was a mistake the administration made. Prior to the election, the country was completely independent in terms of energy production and oil and gas. And obviously, pipelines were shut down, policy changed. And I think that this current administration realizes they went too fast, too soon. It's a fair comment. Let's work on that problem. But
Mm.
let's not forgive one cohort's debt when generations past never got that opportunity. This idea of free money for just the select is absolutely un-American. That is not what built this democracy. It's just outrageous. And the idea that you just pick one cohort, they're the special ones that don't have to pay for their debt. I agree with you. Education costs are too high. Let's work on that problem. Let's figure out a new way to approach that. Let's use technology to maybe make it a more level playing field, but not giving one cohort, just one, the special ones, they get their debt forgiven. Outrageous. Yeah, I've been quite an investor in the Miami market now for 6 years in terms of my allocation of real estate investments. I would say one thing about real estate that's unique as a sector. Now, normally portfolio theory would say this: no more than 20% in any one sector, no more than 5% in any one position. That has
Mm.
been a standard in the indexing market for sovereign wealth and pension plans for 100 years. And I abide by those rules in most of the mandates that I'm involved in managing, with the exception of real estate. In
Yeah.
our operating company, our holdings in real estate now are at 39%, which
Well,
is significantly, it's a heavy overweighting. And the majority of that is in Florida, where are very positive and constructive about the demographics that are occurring there. Now, I've heard all the arguments about Miami sinking underwater, and I get all that. We've been talking about that for 100 years, and there is always that risk in any coastal investment. But when you look at the demographics and demand for properties and office properties in South Beach or Miami proper or Brickell or even Palm Beach or other West Palm Beach and other areas where I am an investor, we haven't seen a 15% correction in any markets yet. There's fundamental demand, obviously, and the consumer remains buoyant. But you're right, we could have that. Traditionally, the real estate cycle used to be 7 years. That has gone, we haven't had a significant correction. I don't care what market in North America you look at, for 25 years. And that's because of change in demographic and demand for housing, both rental and assumed ownership. But you gotta look at it this way: real estate cycles are really interest rate sensitive, as you've detailed. But these mortgage rates right now are still traditionally very low if you go over a 40, 50-year period. I've been an investor in real estate when interest rates are 15%, 1.5. I've been an investor when mortgage rates were under 4. And so at the end of the day, fundamental shelter and housing and office space and demand, industrial demand for real estate remains a constant in any economy at different levels of trajectory. But as an asset class, it has proven to be buoyant for hundreds of years. You know, the old adage, they stopped making it a long time ago. So, these assets people think very long term on. Now, I would
Mm.
agree there's a new reason to consider cap rates going up in industrial and commercial real estate. That's because of new trend in work environments, which are not so focused on office anymore. For most companies now, they have flexibility, and up to a third or half of their employees never come back to the office. And that's probably permanent, particularly in sectors like technology. So that may put some pressure on cap rates for commercial, which means their values go down. If cap rates go up, the building's worth less. However, in the case of residential, the inverse is true because all of a sudden you've got rural communities like Champaign, Urbana, and places where people want to live, raise their kids, go to good schools, get more house for the dollar. Those cap rates or the cost of those houses have gone up and the cap rates have gone down because all of a sudden you don't have to live in Chicago. You can live in Champaign, Urbana, and the lifestyle there on Greencroft Avenue, right on the golf course where I used to live a long time ago. That's a beautiful place to raise a family, and you can still participate in the Chicago community. Yeah. What I say is the lesson that every investor learns over a lifetime of investing. It is 100% impossible to time the market.
Yeah.
100% impossible. Everybody's tried it. Everybody's had their fingers burned. And I'll give you an example over the last 3 weeks. And so if you looked at 2020, which was an extremely volatile year as we started to understand what COVID was doing to the economy and the global economy. The entire returns of that year, which was actually a good year for equities, happened in 19 trading sessions. 90% of the returns happened in 19 trading sessions. That's 8 hours times
Wow.
19. And if you
Yeah.
were not in the market that day when it went up 1,200 points or 800 points or 1,500 points or whatever happened in the volatility, you had no returns whatsoever. The problem is which day. And I remember in March, April, May of 2020, when I was in Miami in lockdown and working with my team on our portfolios, our global operating company portfolios, watching us lose millions of dollars by the minute one day. Unlikely what happened in Britain would occur in our market. I'll tell you why. The
Mm.
parliamentary system has a lot more volatility. It is a system that works, but the prime minister is elevated by their caucus, by their cabinet.
Right.
Same process in Canada. I'm familiar with that system because I once ran for prime minister in that country. I'm a Canadian. I'm Irish. I'm also just recently become an Emirati. And so I'm familiar with these different systems. But in the case of the British prime ministership, um, her caucus, her actual cabinet elevated her to prime minister. She made three bad mistakes, and look, it happens. Politicians make mistakes all the time,
Mm.
but when the bond vigilantes came out, which is when you talked about the guild, their treasury exploded and interest rates went up immediately. That was the market saying these policies don't make sense at this time. And she immediately lost her job. That's the great thing about the parliamentary system. You can whack a politician overnight. That's a great question, but it's self-indexed in this sense. Think of it this way: when you look at foreign capital, well, let's say Norway or the United Arab Emirates or Saudi Arabia, these very, very oil-rich jurisdictions that seek to diversify away from just one sector. It's not that they hate energy or they don't hate energy; they just have too much of it. And so when indexers, and I'm an indexer, and there's many people do what I do, when we're requested to build indices for countries like Saudi Arabia or the United Arab Emirates or anybody, a pension plan, and they say, look, we want to own the S&P 500 without oil, without airlines, because we have our own airline, we have our own oil, obviously, so we want
Mm.
diversification. Now, indexing for a country like Canada, here's the point I want to make: Canada versus the United States is an investment. Canada is uninvestable and it doesn't get indexed anymore because the politicians there are unable to stop gridlock. So if you want to invest in a pipeline or a big R&D project, or you want to do something in mining or copper or commodities or paper or wood, you just get litigated out of the country. And